Hi everyone, today we are going to discuss Aavas Financiers. Housing finance companies have been at the center of the market fall witnessed in September end. Stocks of housing finance companies nosedive following liquidity concerns. While higher interest rates were anticipated in FY19, stock of most housing finance companies fell because they were caught completely off guard on shrinking liquidity and in many cases complete withdrawal of liquidity following the default by IL&FS group companies. Housing finance stocks were once streets' favorite but now are completely shunned by the investors. However, we see opportunity amidst this chaos. Handful of housing finance companies will not only survive but will manage to flourish through this crisis, and Aavas Financiers is one of them. Aavas, which is a mid-cap affordable housing play, is worth the consideration given that the liquidity scenario has considerably improved and also that interest rates are trending downwards with the yield on 10-year government securities falling by more than 80 basis points over the last 3 months. Moreover, we anticipate that affordable housing segment will continue to grow at a higher rates driven by various initiatives of the government as well as the regulatory push. So let's look at the key highlights for Aavas. Aavas's loan book, which is around 4,700 crores as of September end, grew by almost 49% on a year-on-year basis. The most encouraging part about this growth was that it was driven by volume and has been less reliant on the expansion of average ticket size. Aavas's average ticket size has been around 8.5 lakh rupees and management intends to maintain it in the same range of 8 to 10 lakh rupees. Another important and comforting factor about Aavas's loan book is that it has zero exposure to developer financing and land financing. Thanks to this, Aavas enjoys a superior asset quality with gross NPF around 0.6% as at September end. Superior collection mechanism along with the strong underwriting standards and detailed analytics has helped Aavas build a relatively low-risk portfolio. Aavas also enjoys a diversified funding mix with 87% of its funding coming mainly from NHB refinancing, assignment and term loans. Only 13% of its borrowing is from market with zero exposure to commercial finance. Putting simply, it means that the rollover risk has been negligible for Aavas, which was the biggest concern for most housing finance companies during the constrained liquidity scenario days. Despite the high growth rate, Aavas has been able to maintain a very strong profitability with return on assets of around 3%. Going forward, while margins are expected to come under pressure, we anticipate that improvement in operating efficiency will offset the same, and hence we do not see a significant downside to its earnings. So what's the outlook for the stock? At the current market price, Aavas is trading at 3.2 times FY20 books. For a housing finance company that is growing at a very high growth rate and also delivering a return on assets between 2.5 to 3%, the valuation seems very reasonable. Also on a relative basis, the valuations look undemanding when compared to well-established financial lenders like Group Finance and Bandhan Bank, which are also operating in the retail lending space. So overall, we think that Aavas is a good long-term bet available at a reasonable valuation. Investors should consider buying the stock on dips. Thank you.